All right, pause your scroll for a second and lean in. If you watch markets at all, something big just happened. In roughly 24 hours, silver dropped about 21.5%, from around $120 an ounce down to roughly 97. That's about $1.4 trillion in paper value gone, basically overnight. And here's the thing, this didn't happen because people suddenly decided they don't need silver anymore. Both futures exchange data and physical dealers are confirming the same thing right now. This was mechanical. This was leverage snapping. Stay with me, because if you understand what just happened here, you'll recognize it the next time before the headlines catch up. Before I explain what caused this move, let me teach you something most people don't really internalize. Markets don't move on opinions in the short term. They move on positioning. Think of the price like a crowded elevator. When everyone piles in on one side because it keeps going up, it feels stable until the cable jolts. Nothing about the building changed, but suddenly everyone's trying to get out at once. That's leverage. That's futures. And that's why you can see a 20% move without any change in real-world demand. You've seen this in other assets, even if you didn't label it that way at the time. Bitcoin in 2017, oil in 2020, GameStop in 2021. So the first question you should be asking isn't why is silver bad? It's who was forced to sell and why right now. When traders talk about market structure, they're talking about this. Who owns what, how they own it, and what happens when the music stops. If you're watching now, you're ahead of most people who will only see the aftermath. Drop a comment if this framework is clicking for you, because I'm going to show you exactly how to spot this pattern before it happens next time. Now here's what's actually happening under the hood. Silver had gone parabolic. Not slowly trending, not grinding higher, parabolic. That invites leverage. Traders pile into futures with borrowed money because volatility looks like opportunity. When you're trading on margin, you're not putting up the full price. You might put up 10 or 15% and borrow the rest. So if silver's at 120 and you think it's going to 150, you can control 10 contracts with the cash that would normally buy one. That's the trade. But here's the catch. When price pulls back just enough to trigger margin calls, brokers don't ask politely. They liquidate. That selling pushes price lower, which triggers more margin calls, which forces more selling. It's a cascade. It's not discretionary. It's automatic. And when you see a move this violent this fast, that's your first clue. This isn't investors changing their minds. This is positions getting unwound by force. The secondary confirmation is volume and open interest collapsing at the same time. Open interest is the number of active futures contracts. When it drops sharply alongside price, that tells you positions weren't transferred to new buyers. They were closed. They were liquidated. You can see this in the exchange data from the CME. Volume spiked. Open interest dropped. That's forced selling. That's not rotation. And here's the convergence that matters. Physical demand didn't disappear. Premiums in parts of Asia stayed elevated even as paper price cratered. I'm talking about the spread between spot price and what dealers are actually charging for coins and bars. In Singapore, in Hong Kong, premiums didn't collapse. They held. That split is your clue. When paper markets break but physical markets hold, you're looking at a disconnect. You're looking at two different forces at work. But here's the part that should make you nervous and also curious. When forced sellers are done, price doesn't need new buyers to stop falling. It just needs selling pressure to exhaust. Think about that. The way down was mechanical. The stabilization doesn't require optimism. It just requires the absence of forced liquidations. And that's why some of the sharpest bounces in history happen right after the most violent drops. Not because sentiment improved, because the structural pressure released. I want you to watch for that moment. When volatility compresses, when the wicks get shorter, when price stops making new lows even on bad news, that's when you know the leverage is out of the system. Let me zoom out because this isn't new. This is the exact same playbook you saw in 2008 during the liquidity crisis. Silver dropped from $21 to below $9 in a matter of weeks. Not because industrial demand for silver vanished, because everything was being sold for cash. Margin calls across every asset class. Then what happened? Within 2 years, silver was back above $40. Same thing in 2011 after silver's blow-off top. It went from nearly $50 down to $26 in 5 days. 5 days, leverage unwinding, margin compression. And then it chopped for years before the next real move started. And again in March of 2020 when everything was being sold for cash. Silver dropped from $18 to $12 in 2 weeks. Then it doubled to over $28 by August. Every time, the sharpest drops came from leverage unwinding, not fundamentals breaking. Every time, those drops happened near inflection points, not at the end of the long-term story. When you zoom out and look at the pattern, you see violent down moves followed by volatility compression, followed by repricing once the paper market resets. The larger story is this. Markets shake out weak hands before they move on. I'm not saying that to sound clever. I'm saying it because if you study enough market cycles, you see it repeat. The question isn't whether it repeats. The question is whether you'll recognize it in real time or only in hindsight. Now let me be skeptical for a moment because I want you to hear independent thinking, not just hype. Could this go lower? Absolutely. There's nothing magical about $97. If liquidity tightens further or macro stress increases, you could see overshoots. You could see silver test 90, or even lower if fear spreads and more positions need to be closed. And here's the thing about manipulation narratives. Sometimes they distract you from managing risk. Could this move have been engineered by large players? Maybe. Could central banks or bullion banks be involved in suppressing price? Maybe. But whether this was engineered or emergent doesn't change what you can control. You can control position size. You can control patience. You can control whether you react emotionally or strategically. Focus on what price is doing now, not what you wish it would do. The mechanics matter more than the motive. The data matters more than the story you tell yourself. There are probably 3 types of people watching this right now. If you're the person who sold into the drop or got forced out, let me say this plainly. That already happened. The decision was made by the market. Your job now is to breathe, review what went wrong, and not chase revenge trades. Revenge trading is how you turn 1 loss into 3. Take the loss, learn the lesson, move on with discipline. If you're the person holding long-term physical silver, your question shouldn't be, am I down today? It should be, did my thesis change in a single session? For most of you, it didn't. If you bought silver because you believe in monetary debasement, currency instability, or long-term supply-demand dynamics, none of that changed yesterday. Paper price moved, your thesis didn't. So ask yourself honestly, did the reason you bought silver evaporate in 24 hours? Probably not. And if you're the opportunistic buyer, the one eyeing this like a once-in-years setup, patience is your edge. Falling knives stop falling when volatility compresses and sellers disappear, not when Twitter tells you it's time. You don't need to catch the exact bottom. You need to wait for confirmation that the forced selling is done. Wait for stability. Wait for lower volatility. Wait for the price to prove it can hold a range without violent moves in either direction. No matter which group you're in, the principle is the same. React less, observe more. So here's what I want you to answer in the comments. Which of these 3 categories are you in? Are you managing a loss, holding through volatility, or looking for entry? Because your strategy should match your position, not your emotion. So here's where I stand. I'm not panic selling, and I'm not blindly buying. I'm watching. Let me tell you what I'm personally watching. First, I'm watching whether silver can stabilize between 95 and 100 without violent wicks. If it can base here for a few sessions without breaking lower on heavy volume, that tells me forced selling is exhausted. If it keeps making lower lows with expanding volatility, that tells me there's more leverage still in the system. Second, I'm watching volatility itself. Does it compress or stay explosive? When daily ranges start tightening and the swings get smaller, that's often your signal that the structural pressure is releasing. You can measure this with the VIX for silver or just eyeball the candlesticks. When the chaos calms down, that's when you know the reset is happening. Third, I'm monitoring physical premiums, especially outside the US, because when paper breaks but physical holds, repricing tends to follow. If dealers in Asia and Europe are still charging $4 or $5 or $6 over spot for physical delivery, that tells me real-world demand hasn't collapsed. It tells me the paper market is dislocated from the physical market. And historically, when that gap gets wide enough, it closes. Not always immediately, but it closes. Based on my analysis, this drop was structural, it was technical, it was mechanical, it wasn't emotional. The fundamentals didn't change by 20% in a day. Global industrial demand for silver didn't vanish. The supply dynamics didn't shift. The monetary environment didn't suddenly stabilize. What changed was positioning. What changed was leverage. And when leverage unwinds, you get moves that look insane if you're only watching fundamentals. But if you understand market structure, if you understand how futures and margin work, this makes perfect sense. It's violent, it's painful for people caught on the wrong side, but it's not random. If history rhymes and silver can stabilize here and volatility compresses over the next week or two, the move that follows could be significant. I'm not giving you a price target. I'm not telling you it's going to 150 or 200. I'm telling you that when forced selling exhausts and physical demand holds, repricing happens. And when it happens, it often happens faster than the move down because there's no more forced selling weighing on it. Just buyers stepping in against a cleared out market. I'm not a financial advisor. This is not financial advice. Do your own research. Verify everything I've said. Check the exchange data yourself. Look at open interest. Look at volume. Look at physical premiums in different markets. Don't take my word for it. Build your own understanding so the next time this happens, whether it's silver or gold or oil or anything else, you'll recognize the pattern in real time. If you made it this far, you're the kind of person who thinks critically instead of reacting emotionally. That mentality will serve you well in markets and in life. If this framework helped you see what's really happening behind the headlines, share this video with someone who needs to hear it. Subscribe if you want more breakdowns like this, where we cut through the noise and focus on what actually moves markets. Stay sharp out there, think critically, verify the data, and make your decisions before the crowd realizes what just happened.